Just wanted to break down a quick tutorial on how I go about multi-time frame analysis and maybe some tips and tricks on how you can implement that into your trading as well. So let's go ahead and hop into the charts. Typically what I like to do is look for a reason that price is going to go higher or lower on the week. So when we look at the weekly chart, the first thing that draws my attention is going to be just this gap right here. So already at the beginning of the week, I'm looking at that as an area of support. Where we end up testing in that, well, that's up for the week to decide, but this is where I like to begin my analysis. From there, we can hop down to the daily chart and kind of review some of the action that we've looked at in recent videos as well, but we will add another layer to that. So here we see a daily gap, as well as this daily level that was taken out, as well as this daily level that was taken out. So from there, what I'm going to be looking at is potential areas of interest to the upside. So what I'm doing right now is I'm going to apply a fib. And we see that we have an equilibrium of this range. And both times that we've tested it, we've rejected. But in addition to that equilibrium, we also see a fair value gap right here. So we'll go ahead and add that in as well. So we can begin to label some of these things because as we dive deeper, they will only get messier and messier. So a little bit of clarification will help along the way. So from here, we could drop down to the 4 hours, see what we're looking at. 4-hour structure is relatively similar. We see this external high that was manipulated. We see this internal low that was manipulated as well. We see the 50%. And we have a 4-hour gap right here. We also have this 4-hour high right here. So when we drop down to the 60-minute, we'll see what else we can see. We have the same high. We have an additional gap. So as you can see, these gaps are starting to line up, and which gap is going to matter the most is ultimately going to be which gap is the most refined. So we see that this 4-hour gap is relatively large, this daily gap is relatively small, and the 60-minute gap tends to, in this example, is a pretty decent sized gap. So from there we drop down to the 30-minute, 15-minute, and what do we see in the 15? Do we see anything of interest? Not too much. Not too much going on. Maybe an inversion gap right here. So how does this help us when it comes to intraday trading? As we can see, we had an expansion during the New York session. And based on all of the higher time frame reasoning, we knew that this area right here was a very likely draw on liquidity. We knew something up here would come into play. So when we drop down to the 5-minute and start to see how this played out, we have this inverse gap that held after holding this daily gap down here. Actually, this is the weekly right here. This is the top of the weekly. But basically, when you start to dive down into these lower time frames, we see that there was a steep reaction to this upper area. From there, they gave us a bit of a entry model. So you could have looked to get short right here, and you could have targeted towards these lows. We didn't quite take out this low, but also you see it lined up pretty well with that inversion gap from the prior day. And into lunch, we see a bit of a reaction higher. So the main point for this video is to understand that the higher time frames are always going to carry the most significance, and how they interact on the lower time frames is going to be greatly to your interest. What does that mean? Well, as you can see, we had a very important higher time frame level up here, and we saw numerous reactions to this level. How you decided to engage, well, that's ultimately up to you. As you can see here, we have a gap here. We have an inversion gap here. We have a gap here. we had that 5-minute gap that was about right here, which this was the entry for the 5-minute. And we have a bit of a retracement into lunch, which is not unusual. Lunch tends to do the opposite of what the AM session did. If it's not consolidating, it's normally retracing. So using a few basic concepts, old highs and lows, we see that this ran an old high. It also tapped into a nested fair value gap. The reason it's a nested fair value gap is because there's multiple time frame fair value gaps up here. So we can see that we hit some of the consequent encroachment or midpoints of these fair value gaps, but ultimately driving up into this area is going to be an area where you're looking for some sort of reaction or overall reversal. If you're looking to buy up here, you're on the wrong side of the trade. And ultimately, in the long run, that won't play out very well for you. So just a couple examples on how you can combine multiple time frame analysis into a lower time frame trade idea. Hope you got something out of this video. And until next time, take care.